Welcome to today's Explainer. We're diving straight into a highly provocative piece of text today, one that takes a hard look at macroeconomics, fiscal policy, and really the very nature of fiat currency. It's a document that completely challenges the foundational assumptions a lot of us hold about how our domestic banking system actually operates. We're going to take a measured, investigative look at these claims, neutrally unpacking exactly what the author is arguing here. Here's our roadmap for the analysis. We're going to cover the wealth extraction claim, the mechanics of currency creation, redefining inflation, a radical tax proposal, and finally, shifting the burden. Section 1. The wealth extraction claim. Let's kick things off with a seemingly simple question. Where does mortgage money actually come from? When you sit down at a banker's desk to finance a home, what precise mechanics are occurring behind the scenes? Well, the source material uses this exact question as the absolute foundation for its overarching thesis. And the author answers that question with a rather striking assertion. The text claims that, quote, commercial banking institutions and the U.S. federal government actively reach into your private accounts and steal your money every single day, end quote. Now, as impartial observers, it's absolutely crucial we recognize the intensity of this premise. The text doesn't view modern banking as some neutral, passive utility, but rather as an active mechanism of perpetual wealth extraction. Section 2. Mechanics of currency creation. To understand how the author justifies such a strong claim, we need to look at the exact operational mechanics they lay out, which are actually supported by citations from institutions like the Bank of England. It follows a distinct path. Step 1. An applicant gets approved for a mortgage. Step 2, and this is really the crux of the whole argument, the bank creates digital fiat currency via a simple ledger entry. You see, the institution doesn't deploy pre-existing capital or utilize the savings of other depositors. It essentially manufactures new money out of thin air. And then step 3, because brand new currency has just been injected into the system, the absolute purchasing power of all currently circulating dollars is immediately diluted. Now, a bank cannot just create infinite currency without any restraint. It is bound by a regulatory framework known as the capital buffer. Statutory requirements mandate that a bank hold an estimated 10% in liquid assets. We're talking specifically central bank deposits or high-quality sovereign debt. This legal requirement serves as the anchor, effectively authorizing the institution's credit expansion. Let's ground this macroeconomic theory with a concrete, numerical example taken directly from the text. Imagine a banking institution holds $50,000 in equity. Under the current regulatory structure, that $50,000 is by no means the limit of the capital they can lend out. Rather, that initial $50,000 legally anchors the creation of a massively disproportionate mortgage loan of $500,000. The bank leverages its capital buffer to literally write a new ledger entry into existence, one that is exponentially larger than its actual physical reserves. So you might be wondering, how do these institutions maintain those required baselines to sustain this compounding credit expansion? The text points to 3 primary methods: securing overnight liquidity from peer institutions, accessing the Federal Reserve discount window directly, and relying on unchecked federal deficit spending. Working together, these mechanisms allow commercial banks to maintain fractional reserves and just keep generating new digital dollars. Section 3. Redefining inflation. This granular understanding of banking mechanics leads the author to radically reinterpret a very common economic term. Now, public perception generally views inflation as just a simple increase in the cost of goods and services over time, right? However, the source text posits that inflation is actually a sanitized, bureaucratic term, one specifically designed to mask the ongoing wealth extraction and currency dilution being executed by private banks and the federal government. The argument here is that prices aren't simply going up, your money is fundamentally worth less. And the conclusion drawn from this redefinition is notably grim. The author argues that because every newly generated digital dollar actively erodes the stored value of existing capital, preserving generational wealth becomes structurally impossible for citizens holding depreciating U.S. fiat currency. The system, according to the text, is quite literally mathematically rigged against the preservation of your savings. Section 4. A radical tax proposal. Having outlined this perceived structural problem, the second half of the source text pivots to a sweeping legislative solution. To counteract this continuous erosion of purchasing power, the author proposes massive, and I mean massive, statutory exemptions before any individual tax liability is even incurred. Under this new framework, an individual would require a liquid savings baseline of $300,000 and an annual income threshold of $1 million just to be taxed. For those married filing jointly, those figures double to $600,000 in savings and $2 million in income. The goal here is to completely insulate citizens until they achieve true verified capital accumulation.
Furthermore, the proposal dictates that these baselines must be pegged directly to real-world inflationary expansion. The author absolutely rejects Government Consumer Price Index, or CPI, metrics, basically dismissing them as highly manipulated, fraudulent propaganda used to obscure the true rate of currency depreciation. By bypassing CPI entirely, the framework aims to protect working citizens from what the author views as the silent drain of the fiat system.
Section 5. Shifting the burden.
Now, a logical question arises. If working citizens possess zero tax liability under these new exemptions, who actually funds the government? Well, the proposal advocates for a dramatic shift in fiscal responsibility. The burden moves entirely away from standard working citizens and falls squarely onto corporate entities and high net worth individuals, the ones who already hold assets and incomes exceeding those proposed macro baselines. Higher progressive tax brackets would be restricted exclusively to these upper echelon entities.
The core philosophical intention behind this massive restructuring is summarized pretty forcefully. The author states that the tax code must cease penalizing citizens who are simply trying to survive U.S. federal government and bank monetary devaluation. It's essentially a clarion call to recognize the invisible tax of inflation and adjust the visible tax of the federal government to compensate for it.
We've covered a significant amount of highly critical economic theory today. But as we wrap up, I want to leave you with a final thought to ponder. How does the hidden machinery of modern banking impact your own ability to preserve wealth? Whether you agree with the author's radical proposals or not, the text certainly forces us to look much more closely at the digital ledger entries that quietly define our broader economic reality. Thanks for joining me on this explainer, and keep questioning the financial structures around you.